Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good evening, all. Ira Epstein with your financial update for this Tuesday evening at 6 p.m. Yeah, I'm here late in the studio. It's 6 p.m. Central Daylight Time, and this is obviously for October 17th, Tuesday. All right, we're in Wednesday's trade. I know it sounds confusing. It confuses me half the time. Markets reopen in Chicago, the electronic Globex markets at 5 p.m. for Wednesday's trade. Now, some of the markets, like the grains, open at 7 p.m. Central Time. Some of the soft commodities don't open till later in the evening. But for the majority of markets, we're already open. And as you can see, the stock market, we've had a break in the Russell, and that didn't come as unexpected, and I'll show you that in a minute. But all the other indices are just acting powerful as can be. They refuse to drop. We saw the API data. It came in with a 7 million barrel decline in crude oil stocks, but we were up in gasoline and in distillates, and they weren't looking for that. So now the question is, how does the EIA data come out? And the fear, of course, should be in many people's minds, as you keep moving up in crude oil, what happens as you get up, say, to $53 to $55? Does that bring out more shale production? Don't know. Was the market expecting a big decline in stocks? It was. 4 million barrels. They got 7 out of the API. We'll see what the EIA does, but that's the estimate. On a weekly chart, and that's all that I'm looking at, are closing prices. You can see how the market's going straight on up now without so much as a major hiccup. When you come to a daily area chart of closes, tonight you're down 50 points from the all-time high close. I mean, a half a tick. It's pretty important, a half a full handle, as we call it. When you take a look at what's going on, are you noticing that the ranges are narrowing in a bit? That's got a lot of analysts concerned. I keep reading about people trying to pick tops and telling their clients not to be in. Well, just think of how they have felt this rally. But their concern is you're in a time frame, you're in an area of valuation. I was on today in Australian Sky Business TV, and I mentioned that, you know, what the market has done is it's gotten through an ugly September, it rallied. Now we have a good quarter ahead of us, typically on a historical basis, and the market is now looking at earnings, Johnson & Johnson, United Healthcare, and everything that's coming out is still supporting the market. On big breaks, would we get something like a Black Monday that we had in '87? I doubt it. There's so many different controls in places from then. Doesn't mean you can't get a correction at any point. In the S&P, the swing line, you've got uptrend, higher lows, higher highs, bullish. You're over the 18-day moving average of closes in the 100, bullish. The market had hit the upper Bollinger Band, has gone sideways, so it's ready to do what? It could be ready to accelerate again. This, to me, and I've said it to you over and over, is on this particular type of chart, when you get an embedded reading, it takes the leadership away of everything else. It wouldn't even matter if you break the swing line. This is the key. As long as both numbers are staying over 80, going sideways, it's bullish. Now, there will be a point in time where it gets ahead of itself, and you know, you can only go to 100, so you're getting up there, and you've got to have concern. You don't close your eyes that it's just going to go up every day. The Dow's doing the same thing. The embedded reading, higher highs, higher lows, some sideways action. Is it going to make a run to the next high, which is 23,105? Yeah, that would add another 100 points to today's record. When we look at the Nasdaq, an embedded reading, this index came to the party late. It had been breaking down and moving there. And the market that, at least I had the momentum right if you get my newsletter, because I said this chart looked like it was ready to set back. We had an outside day down yesterday, and when you reopened last night, when I sent out my newsletter, the market even higher on the evening, had lost its embedded reading. So the odds were that price and the 18-day average were going to make a run at each other, and they did it today. Remember, when you reopen that moving average, it's going to take the last price and use it as a settlement to compute itself back and forth. That number got to, let's round it up, 1497. The low today, 1495.60, and you can see the market held it at this point. The problem for the market is this index doesn't re-embed now. It would have to have a major move tomorrow to the upside to do so. So, can it? Yeah. And I'm not saying, I said it's not, can't, no, I'm wrong on that. It can if it had a big rally tomorrow. You can only lose the embedded reading one day. In the VIX, do you see the sideways action? I want you to think of the black lines representing a pipe, the circumference. And inside of that pipe, price is moving now very tightly. It's like a spring in the pipe. It's winding itself up. In the past, it's been very hard to get big breaks in the VIX because you're so low. Every time you get down to 9, to get another 5% break's only going to carry you to 8.5. But if you're here at now 10.3 and you go up 10, 11 points, 10%, you get a rally that's more like up here. And that's what's happened out of the past sideways action. So pay attention to that and just understand, because of the steep decline in price, how upside versus downside momentum springs, as we'll call them, can work. In the TLT, this market typically looks at the medium-term interest rates, and it's still saying that they're in a bull market. Higher lows, higher highs. It's a popular ETF, but it's overbought as can be. When you're overbought, you don't necessarily reach up for the upper Bollinger Band. Can it? Yes. Is the trend up? Yes. But taking out 125.36 could be a warning sign. The bond market is getting different types of action. As the curve yield is coming flatter, what's happening is the low end of the market, the 2-year, 5 years, are coming up in yield, but this market's already set in place, and what you're getting is, as this rallies, you're getting lower yields. Remember, it's an inversion market. It is overbought, like TLT. It's over the 100-day average. Will it reach up here for 154.28? It could, but if you take out yesterday's low, I'd be a little bit cautious. In the 10-year notes, you seem to be stuck at the 18-day average of closes as you're developing sideways Bollinger Bands. Now, they're not super narrow, but they're there for you to pay attention to. And strong resistance is now 125.29, the 100-day average, up to the Bollinger Band. The pivot seems to be right here at this 18-day average. The trend remains up until you actually take out this low here, which is closer to the 125 area. The dollar index, let's see if I can catch this for you. You've got a market that hit an upper resistance band all the way through here, has fallen back, and is regrouping itself against the 18-day averages. It's probably waiting to see what interest rates are going to do, what's going to happen with the Fed, blah, blah, blah. But right now, the economic data in the U.S. has been pretty good. While you're not trending, you have upside bias, and you've stopped downside momentum for the time being. If this market were to take out 92.59, it would, in essence, have lower highs and then a lower low. The problem is, when this market gets there, where's the Bollinger Band going to be? It's going to be so close to it that is it worth pursuing. In the euro currency, it's a flip-flop. The market's fighting or trying to fight at the 18-day average of closes. Obviously, here's the 100-day average. It's the exact flip-flop of the dollar index, and here's your lower Bollinger Band. So if the market rallies up and takes out this high to create a pattern of higher lows and higher highs, you're right into the top Bollinger Band. In the Aussie dollar, you're just riding sideways right now, not giving an idea of where you're headed, with a higher high and a lower low. Japanese yen, the market has got higher highs, higher lows. Momentum in the market is overbought. You got a reading over 70, so it's vulnerable on the downside. Again, narrowing of these Bollinger Bands, typically a sign that a market's just spinning its wheels. Now, we get requests about what's happening in Brent versus WTI crude. I think the most important chart is not the Brent by itself. It's this part, if you're paying attention to it. And what it's done is each break that has happened has been holding currently the 18-day moving average of closes on this line chart. And the line chart's giving you an idea where you're at. The premium difference now is Brent over WTI by 577. If Brent takes off to the upside, this may just either continue with it or you may see a narrowing of it in some manner. My guess is that American producers would only love to produce more oil for export because at a $6 premium, it pretty well pays for itself with shipping charges. In the November WTI, the trend is up. You are overbought. The API numbers today came in, I thought, interesting. You had a 7 million barrel decline in the crude stocks. You saw gasoline and distillates gain in stocks. Tomorrow's report of the EIA is only predicting a crude oil stocks decline of 4.5 million. So we're going to see which one is right. But either way you go with it, you've had an uptrend, good demand for the market, and you're not building stocks of at least crude oil. I'm not surprised to see gasoline or distillates build some stocks, and I don't think most people are at this time of year. Higher lows, higher highs, support back at 160.34. Gasoline is still bucking the seasonality of a decline. It is overbought as can be. November natural gas, you want to get whipped, trade this market right now. Every day that a new weather forecast comes out, you're going to get yourself hurt back and forth here because the market is not yet at a wintertime demand. It's trying to figure out what is the demand at this point. So as I put it all together, I write about it. I write 2 market letters a day. In the morning, I start you off with, I wish you were here because I'd give you a cup of coffee, but I start you off with my cup of coffee, and then I review 40 charts in the morning in a separate video you need a user ID and password to get to. If you haven't tried it, you're welcome to get a free trial to it for 30 days. I think that's calendar days. I think you'll find it well worth your time, effort, and maybe I'll throw an idea or two at you. If you're a subscriber, you know what I'm talking about, and that's the interesting part. So how do you get it? And this is what's included. You can give us a call. My staff will get you set up right away. You can go to our websites for Ira's Market Research. It's a free offer if you want to subscribe. Under the word research, it lays out how it all works. Very inexpensive, by the way. You can click here if you're watching me on YouTube, or underneath us on many websites says click here for Ira's free information. I'm Ira Epstein. Sorry I'm so late today. You have a good evening.